This was a treat to watch. The more lucrative that the stock market looks even for the average investor, the more that we're seeing new entrants try to buck the trend of influx trends and funds and take the reins of their own portfolios. Dave Ramsey was caught in the middle of that divide when a rather hostile caller came out of nowhere, calling him names while criticizing his approach to actively managing funds. But I think there's some statistics and data that were quite off in this abrupt segment, which is why I want to take a deeper dive and salvage some important lessons. Of course, this isn't financial advice, do your own research, but subscribe to the channel for more discussions like this before we dive into it.
Hey, Dave, how are you doing?
Great, man. What's up?
There's a couple things. One, you've done some great work, and in some ways I love you. In other ways, you're stupid and arrogant.
Okay. How can I help you?
All right.
By the way, that's a great way to start any conversation right there.
Yeah.
Yeah. Well, my first question would be, are you smarter than Warren Buffett?
How old are you?
Because you push, I'm 35.
Okay, cool. So
you
what?
push
I'm sorry.
people
Let's stop just a second. What's the point of your call? How can I help you?
The point of my call is you push people into actively managed funds when over time, if you pushed people into an index fund, they would have about 50% more money when they retire.
Okay. Not sure where you went to school for your math class, but you failed.
As much as this caller might think so, it doesn't actually have to be that false dichotomy between actively managed funds versus index funds. That's because people like Dave Ramsey and Warren Buffett are the outliers, and they're not like the average investor whose primary concern is playing it safe at low cost. That's evidenced by the fact that even one of the greatest investors of all time, Warren Buffett, advises the general public to go for the tried and tested safety of index funds like the S&P 500, which may not give you the highest returns in the short term, but offers a great opportunity for compounding investment over years and decades. Warren remarked just earlier this year that, and I quote, "In my view, for most people, the best thing to do is own the S&P 500 index fund. The trick is not to pick the right company. The trick is to essentially buy all the big companies through the S&P 500 and do it consistently and do it very low cost way. The S&P 500 averages a return of about 10% per year before adjusting for inflation. That's certainly subject to price dips and rises in the short term, but shows a steady upward trajectory given the companies that make up this stock index are built on solid foundations to become the top 500 companies in America by market cap. And generally speaking, the diversification of this index fund is what lends a degree of security over a more aggressive and actively managed fund like a mutual fund. So the difference is really of a school of thought. For example, someone like Robert Kiyosaki might tell you that, quote, diversification is just a defense against ignorance, and even Warren Buffett will invest in actively managed funds using his holding company, Berkshire Hathaway, as a vehicle. But both of these people will also agree that actively managed funds are not the best recommendation for the millions of everyday people that may want to invest.
I got socks older than you. I've been teaching this a while, okay? So this is how this works. Now, here's the thing. You're basically doing what Bogle said, and Bogle invented a wonderful thing with the index fund, and the S&P 500 funds are wonderful. The index funds are wonderful. They are not a cure-all, and there's no possible scenario, unless you're an absolute idiot in picking your actively managed funds, that you would have 50% more in an index fund. Now, the actual facts are more than 50% of the funds underperform the indexes. That is a true fact, to your point.
That's a different fact.
The
fact is 2% above, if you have a 7% return versus a 9% return, which you have the compounding cost bringing your return down by 2%, over 50 years, you'll have half the money. Do the math on that, Google it.
That would be true too, but none of those numbers you're using are accurate in terms of what the S&P has produced or what actively managed funds have produced. The actively managed funds that I personally have picked have outperformed the indexes by more than 2% as a portfolio, because it's fairly easy to study mutual funds and pick them that outperform. But if you're not going to study them and you're not going to have a good advisor in your corner, then using the index funds is a great idea.
I think it's easy to miss something here. It's that all actively managed funds or mutual funds have an entire team of dedicated financial professionals picking the right stocks who need to be paid and incentivized. This massively raised the cost and fees of investing money into an actively managed fund, potentially eating into any marginal profits that you'd be making anyway. An index fund is usually a low-fee fund in below 0.1%, but actively managed funds can accrue fees closer to 1% or even more. So, given that historically speaking, even successfully actively managed funds don't outperform index funds by more than 2% in the long term, it becomes a question of whether taking on that increased risk and fees is really worth it for the average individual. Of course, there's very little that you can predict in the world of finance, and it's possible for someone to gather enough wealth to be able to take that risk for a chance of greater reward, but that doesn't really render either of these investment strategies redundant. Instead, they're two different schools of thought that work in tandem as a holistic investment strategy for most people, including Dave Ramsey himself. However, the figure that this caller just gave of index funds performing 50% better than actively managed funds is still massively off and reveals a complete lack of understanding of most actively managed funds, if they're even nominally well managed. What makes index funds alluring is their low fees and security because of diversification into reliable stock indices. That makes them a good vehicle for investment that needs that long-term reliability. For example, retirement funds and 401k accounts, that's why you see an increasing trend of retirement funds going into index funds in general, although account holders have an option to allocate some of their savings into a more actively managed fund if they believe it can benefit them in the long term.
Let's go back to Warren Buffett for just a second. Are you aware that Warren Buffett does not have all of his investments in index funds?
Of course.
Okay,
he has
good.
it in the holding company.
I'm not sure, other than the fact that he has stated that the average guy, because he's a Bogleite, the average guy should buy index funds instead of actively managed funds. Other than that, he doesn't actually do what he says he's going to do. With that, he actually has an actively managed portfolio called Berkshire Hathaway. Are you aware of that?
Yes, I am, and he's doing it with the money he's leaving to his wife when he dies.
Well, that's fine. I mean, where the money's going is not relevant to the mathematical discussion. The mathematical discussion, Chris, is simply this. Warren Buffett made comments frequently about the average guy should buy index funds, and I really don't have a problem with that. You can get rich with index funds. Not 50% richer. That's complete BS. But
that is true.
But you can get rich with index funds. I don't have any problem with that at all. If that makes me arrogant, fine. But I think we're confused as to who's arrogant on this call, brother.
It was truly something to hear that caller come at Dave like this, despite displaying a glaring lack of understanding that both types of funds are useful as part of a larger investment strategy. I like how patient Dave Ramsey was throughout, which is perhaps a good metaphor for the patience required in the world of investing as well. By definition, it means having a stake in the overall economic well-being of the business that you're invested in and trying that to your own financial stability. Some people may have the gall to want to accelerate that process by betting on a particular horse, which is in some sense what an actively managed fund does. But for the vast majority of hardworking middle-class people whose lives and financial future cannot afford long-term losses of more than a few percent, being more financially conservative in investing is a better bet. A study last year from the Federal Reserve revealed that nearly a third of Americans can't meet a $400 emergency with cash, which just goes to show the investment approach that's more appropriate for them is long-term safe investing. Let me know in the comments what you think about this conversation, because it certainly is a window on how to have the right attitude and patience. It is so important in the world of investing.